Good afternoon, everybody, and welcome to today's Professional Advisor Working Lunch, brought to you courtesy of our partner, Baillie Gifford. I'm Jenna Brown, Deputy Editor of Professional Advisor, and I'll be your host for the next hour. Before we get going with today's session, let me quickly run you through the usual housekeeping. I should inform you that the session is being recorded, and we will be sending you a link of the recording by tomorrow. Do feel free to share this with your colleagues. As usual, today's working lunch will qualify for 1 hour of CPD, and we'll be sending you your proof of attendance along with the link to the recording of the session, which will arrive in your inboxes tomorrow. So now let's get on with the session. Small and mid-cap stocks in Europe have endured a torrid time in recent memory, with attention and flows focusing on the larger end of the market. With cyclical tailwinds emerging, is it time to redress this imbalance and allocate towards structural potential winners lower down the cap spectrum? Well, that's the question our guest speaker today will be addressing. I'm delighted to be joined by Tom Hodges, Investment Specialist Manager of Baillie Gifford's European Fund, who will be offering his insights on the subject over the next 40 minutes or so. Do feel free to put any and all of your questions to Tom using the chat function, which you will find at the bottom of your screen. So, just before I hand over to Tom, let me quickly run you through our learning objectives for today. By the end of the session, delegates will have learned about the historical performance of small, mid, and large caps in Europe, understood why many growth investors find many of their ideas in the lower reaches of the European market, heard about the secular and cyclical opportunities in Europe. So that's the CII and CPD covered. Let's hear from Baillie Gifford's Tom Hodges. Afternoon, Tom.
Thanks very much, Jenna, and thank you all for joining today. It is certainly an interesting time to be speaking about equity markets, and particularly with the initial sort of lead up into the presentation, which spoke about cyclical tailwinds. But fortunately for me, the presentation details were submitted in advance, so I will resist the temptation to get my macro forecasting crystal ball out and opine on the last few weeks, and instead try and speak about an area which, in the European team at Baillie Gifford, we perennially find interesting, and that is the lower reaches of the European market cap spectrum, small and mid-sized companies, for the next about 15 minutes. So we'll have plenty of time for Q&A. And as Jenna alluded to, it's been a really rough time to be invested in smaller companies globally in the past few years. And we'll look at that in a European context. We will consider what's driving this prolonged bear market for these smaller companies, the scope for a rotation, and then why we in the European equity strategy at Baillie Gifford, despite being an all-cap strategy, remain long-term buyers of smaller companies. So I started working with European equity strategies back in 2015, and ironically, given where I'm employed today, I actually started sat next to a European value manager. And I distinctly remember regularly bemoaning how expensive smaller companies were relative to larger ones and indeed the broader market. And it's interesting when you look at these charts, because looking back over the past 20 years, it was almost an unwritten rule that small caps would outperform. So from about 2000 to 2010, small caps outperformed the broader index by about 70%. And then from 2010 to 2020, those 11 annual periods, the small cap index outperformed the broad index and large caps by 7 out of those 11 annual periods. And on a total return basis, the small companies index outperformed the broad index by about 37%. Now, that's all begun to change. Since 2021, large cap has actually outperformed. It's delivered about 17% total return versus small cap of 7%. And at this point, it makes sense to consider the differences between smaller companies and larger companies in Europe. Larger companies are better known for being more defensive in Europe, whereas smaller companies are known for being slightly more economically sensitive. And just to give you an example, the largest sector in the small cap index is industrials, about 25%. That's more than 10% greater than in the large cap version of that index. And so when we moved into the COVID period, particularly small cap growth stocks, they saw a supernormal growth period begin to come through. So where you've got a lot of B2B type businesses, B2B medtech businesses, distribution type businesses like in specialty chemicals, or even the different variety of digital platforms, what they saw was many of their customers seeking to avoid supply chain disruptions by double, even triple ordering. And so we saw massive growth come through. This was even pushed higher by being able to push through inflation through to their customers. But these effects have begun to roll off. Even us as consumers, we're spending less on goods and more on services now that we're actually allowed out of our homes. So we've seen a severe normalization as these growth effects have rolled off. And since then, we've actually seen earnings decline. So in that sense, it does make sense that the performance of small caps has been weaker. And indeed, it's seen a reversal of longer term valuation trends. So for the better part of the last 20 years, smaller companies have traded at a premium given their higher growth nature to large caps and indeed the broader index. But now we're seeing large caps and the broad index trade at a premium. And I'd reiterate, larger companies in Europe, they're generally associated with being high margin, fairly safe and stodgy companies, and that plays well in a period of uncertainty. But the question we want to ask ourselves is whether that the current weakness is already priced in. And we think there's an argument that it has been, particularly should we see a pickup in those areas I mentioned earlier, particularly in those B2B type businesses. So, and despite everything that we've been hearing a bit more recently, there are signs that this is beginning to come through from a low base. So German mortgage volumes are beginning to recover. We're seeing a pickup in the early stages of the semiconductor cycle. We're also seeing drug contracting volumes come through for drug manufacturers. And M&A activity is emerging in pockets. And so it's not a surprise then that for next year, the Stock 600 small cap index is forecast to grow earnings 14%. That's about double that of the large cap index and almost double that of the broader index. But as you can see, that's not really being priced in to valuations just yet. And I've included this slide on concentration because it's a big topic, but it's not necessarily something I want to spend a great deal of time on. It's really just here to provoke some food for thought, because you can see that concentration has been a powerful force in Europe of late, just as it has in the US. But is that as justified? Now, for the uninitiated, the granolas are 13 of Europe's largest companies. They include high growth companies like ASML, Novo Nordisk, and also the well-known old guard of Europe, so Nestle, Roche, etc. And while some are at the vanguard of megatrends, like Novo, like ASML, others really, I think it would be hard to say, have the same long-term growth prospects as the Magnificent Seven and those being emboldened by AI. And so really, I think part of the attraction, why the granolas have contributed such a large amount to stock market returns more recently, is the fact that they exhibit lower volatility, they're high margin, stable balance sheets. It's that feeling of uncertainty. So again, it's trying to build in a question of whether there is scope for a rotation, and this isn't necessarily a secular trend which is going to continue for the long term. But moving on to why we have been long-term buyers. As I said earlier, we are an all-cap strategy. But you can see from the slide that about half of our fund is, or more than half of our fund is invested in companies with a market cap lower than 25 billion. But why? Well, to put it bluntly, it's the potential for higher returns. What we look for is generally a large growth opportunity, competitive advantages which can make that growth opportunity durable, and the management or ownership structures which offer really strong capital allocation track records. And when you analyse the big winners in Europe over the past 30 years, the median starting market cap for a 10-bagger in Europe has been roughly $2 billion, so skewed towards the lower end of the market. And they've grown revenues consistently around or above 7%, whilst expanding their operating profit margins. So not necessarily starting at a high point for margins. And what we found is that lower down the market cap spectrum, when we reflect on these growth opportunities, is that there's so many global leaders in this part of the market dominating their industries. And that's sometimes present in sort of picks and shovels opportunities and some really powerful secular trends, such as the biological revolution, the semiconductor value chain, electrification, and more. And then there's the quirkier names, the many serial acquirers that Europe offers, where M&A is central to their growth strategy, and they're growing over very long periods of time, regardless of the cycle. And the great thing for us right now is that these companies really have quite bright prospects for the long term, but that's not being priced in. They're trading at a discount to what we believe they can become. So what I'm going to do now is run you through three such companies. One virtual monopolist in the semiconductor value chain, one oligopolist in electrification, and then one of those quirkier names, one of those serial acquirers. And I doubt too many of you will be all too familiar with each of them. And the first is Soitec. Soitec's a French company. It is the leading manufacturer of silicon on insulator wafers. It's got about a market share of 65 to 70%. And it's a great example of a company which dominates a structural niche, but where its share price is being overridden by cyclical concerns, and that's not really reflective of its long-term opportunity. So silicon on insulator wafers, essentially it's a really thin substrate which is put on to a semiconductor chip to boost its performance. It comes with power efficiency advantages, and that comes into boosting performance versus the more traditional substrate, which is bulk silicon, and that still makes up 98% of the wafers in use. It's skewed towards the mobile phone market, and it trades like that. About 61% of its revenues come from mobile phones. But over time, we expect that to begin to shift. The company actually thinks that by 2030, its total addressable market will have grown by 7 times as it incorporates growth and demand from electric vehicles and industrial applications. So its smart SiC product, for example, will boost battery life and reduce powertrain cost. And so over time, what we expect is the mobile phone market to begin to pick up again. We're due a replacement cycle, and that will come with higher semiconductor content, which is good. But also, we'll start to see demand come through for EVs and industrial applications. And moving on to Nexans, another French company. And Nexans is one of the world's leading manufacturers of cables for industries like construction, but more interestingly and more central to our growth case, in the offshore wind market and subsea interconnectors. And it's been an interesting ride for Nexans. It's been a company which has destroyed more value than it's probably created in its history. But it's really now focusing fully on the electrification angle. And electrification cables, unlike the broader energy generation or renewable energy generation industry, actually comes with really high barriers to entry. These cables require huge factories, they require huge ships to transport them, and they also involve an awful lot of IP. And so what we have as an industry structure here is 3 main players, and Nexans is one of 3 companies which has constructed and delivered around 90% of the offshore wind cables ever made. It's one of only 2 companies which can install these cables at a depth of 2,000 meters and below. It's actually manufacturing the longest submarine cables in the world currently for an EU project which will connect the power grids of across the Mediterranean. And in the past few years, what we've seen is a bit of we've seen some doubts over the viability of many offshore wind projects, given the discount rates that were originally involved. Those fears have started to subside. Projects are being funded, and Nexans is seeing some momentum, like as I mentioned, in that area of the Mediterranean. And so what Nexans really represents is a picks and shovels opportunity in a multi-decade growth story. And moving on to Instalco, once again, it's a niche business, somewhat of European quirk. It's a Swedish company which grows via acquisition. It's consolidating the incredibly fragmented Scandinavian technical installation markets. I think things like construction, for example. And it's buying up several companies a year, something it can continue to do for a really long time because it's focusing on small companies. I mean, really small. It's these companies which do roughly 2 million to 3.5 million in revenue every year, of which there are thousands. And it's essentially an area where private equity is not looking. So the competition for deals is much lower. So what Instalco and other serial acquirers, and we own several, are essentially doing is buying cash flows. And with more cash comes more acquisitions, and that begets more growth. What that essentially means is you have a self-reinforcing flywheel, and that's enabled Instalco to have compounded its free cash flow growth at 33% since 2017. And we think these high growth rates can persist despite the share price reflecting, again, cyclical weakness in the construction market. So again, it's another question of just how much of that weakness is already priced in. And we were delighted to take a position recently. And these are some other examples of stocks we hold at a valuation or a market cap below $20 billion. It highlights the diversity of secular long-term growth opportunities that this part of the market offers. Now, we could have spoken for a while about the pioneering work of Camurus in long-acting injectable drugs, or speak about Genmab and its development of the world's leading antibody drug platform. We could have spoken about the enduring growth opportunity that VTech has in consolidating the vertical market software industry, or the growth opportunity that Dino Polska has as a grocery chain expanding rapidly in rural Poland. The list really does go on. But to sum up, before I hand over for questions, looking further down the market cap spectrum in Europe really presents the opportunity or possibility of accessing some really enduring growth companies. And right now they trade at a discount to the broad European market and to European large caps. And this is a reversal of historical trends. And while it has been prolonged, we don't expect this situation to last forever. So this is definitely contrarian, but growth at a discount always sounds attractive to me. And perhaps it's become even more contrarian with the uncertainty out there at the moment. But perhaps it is time to think about the opportunity for longer term returns beyond the next year. So with that, I'd like to thank you very much for your attention, and I will pass back to Jenna.
Thank you very much for that. We have had quite a few questions come through, which is great. Just kick off with one. There's two actually concerning the US, even though we're talking about Europe, but obviously there's the US election coming up in November. And do you see this having an impact on European shares?
Well, the outcome of the US election has become substantially less predictable in recent weeks. So that's one variable which is quite hard to figure out. I think, previously when we were thinking about the potential of a Trump administration, the primary impacts would be around geopolitics, and particularly around big areas like semiconductors and also in healthcare. but also in the raising up of tariffs. And that would actually have potentially an inflationary effect. So that has a longer term impact on the structure of interest rates. And but also it does squeeze it does potentially squeeze the cost base of different companies. With regard to the geopolitical angle, particularly around semiconductors, we've seen a lot of volatility in semiconductors in the last week, but prior to that as well, particularly with actually the Biden administration threatening some increasing curbs on selling high-tech equipment to China. But whilst that might be an issue at some point, certainly we don't expect it to curb the overall semiconductor opportunity. The other angle is where we're seeing geopolitics favor some of our companies. So are in healthcare, where there's an act which is being pushed through Congress, a bipartisan act, I believe, as well, which would prevent drug companies from having their drugs being manufactured by an outsourced player in China or by a Chinese company. We own a company called Lonza, which is actually a large cap, funnily enough. And that would be a net beneficiary of that as one of the largest players. But overall, I think the key for us is to really focus on secular growth companies, which should offer opportunities for 5-10 years and beyond, and grow fairly predictably in that sense, rather than those which will be at the whims of politics. Yeah, there will be some volatility around it. We can't be sure just how much it will affect us. But I think if you are orienting your portfolio towards those kinds of opportunities over the long term, it should benefit you.
Mm-hmm. And of course, there's political change happening across Europe as well. I suppose. What's your insight in that?
Insight's an interesting way to describe it. I certainly wouldn't proclaim to have much insight. I do actually have a politics degree, but I wouldn't be able to tell you what it really taught me. So again, we are seeing some pretty worrying trends around increasing nationalism and different pieces of political change. I think again to actually, probably the one thing I have learned from my politics degree is a politician's answer, and I think again it's probably trying to focus on those companies which aren't going to be get tossed up in the various political winds, and actually are solving some kind of degree of friction in society, or have a growth opportunity which doesn't require that kind of political tailwind behind it. Serial acquirers are a great example of that. They're investing in Main Street businesses. These aren't sort of big deals that everyone's seeing in the headlines, and because they're operating in such fragmented industries, we can just see them continue to grow over time. There's a company which we own called Baillie, which is an HVAC distributor, but it's a serial acquirer of that HVAC distribution market. Growth this year is effectively flat from an organic perspective, but it's added 10% in acquired growth. So whilst the cyclical winds might blow and cause some issues for some companies, the opportunity to supplement or move away from that by pulling a different lever, that's always attractive.
Mm-hmm. Another question here is, what do you think it will take for smaller companies to outperform again?
I think the bigger point is around the return of risk appetite in the near term. That would be the key thing. How and when that comes through, that's anyone's guess. With increasing economic softness that we've seen a bit more recently, and that's helped to spook markets somewhat. Maybe we'll see more cuts than were initially forecast. I don't know, but generally, I think the bigger point is the market is kind of in show me mode for these types of companies, and what these companies need to do is a bit of what I mentioned earlier, which is produce that operating performance, that fundamental performance, and it's seeing that demand come back through. And so for some of the companies that we mentioned earlier, they are being priced as if demand will not return. Soitec, for example, is expected to deliver slightly less than negative growth this year in revenues, but next year it should grow by over 30%. ASML in semiconductors is similar. And I know that's a large cap, but it's a sign of how people are really focusing on the near term with a lot of different companies. And in the coming few years, given that comps have been so weak, they're as I said earlier, their earnings have actually been declining in recent years. Pretty much all the growth is going to be generated by these smaller companies. And if we do believe, and I certainly do, I hope everyone else does, that earnings and free cash flow growth do eventually pay off and drive the share price returns, then these companies will be in a good position. And the attractive standpoint for us right now is that if we're investing in them now, as Instalco is a very recent purchase, for example, we're doing that at a very, very cheap level. So I think the starting point is very attractive.
Mm-hmm. Another question come through here. How tough is increasing concentration, making it for active managers to outperform?
I think it has been perhaps a bit tougher. I think it does force you to ask yourself some different questions. I think, as growth managers, we've generally, we are index agnostic. We don't spend too much time thinking about the index. But it does make you think that with the upper end of the market becoming ever bigger and you are seeking to outperform that market over the long term, you do need to go back and ask yourself a question around the largest companies in the index and whether you are happy to actively be against them. It's almost somewhat shorting them to some degree. So I think that's a positive exercise that it makes, but it certainly in the near term, it has made it harder to outperform. I would go back to my comments, though, around the difference between the US and Europe. I think the move for concentration more recently reflects the fact that this basket of companies is incredibly liquid. That's very easy for hedge fund managers to access when they want to buy Europe in the short term. But also, it's this high margin, defensive, stable balance sheets, low volatility way of accessing Europe. And when you are feeling less risk-friendly, perhaps, this basket becomes more attractive relative to other styles or even parts of the market. So I think, again, if we are sort of more or less coming towards a bottom for demand in various industries, and we do start to see growth come through for traditional growth companies in Europe, for the type of higher growth companies that we invest in, there's real scope for that to unwind. I think going back to some of the volatility over the last week, the fact that we did see such volatility was probably the unwinding of what had begun to sort of be a bit of a risk-on position, perhaps in the US, but also in Japan. I wouldn't say that positioning in Europe has been quite so risk-on. We didn't, where the US saw a rotation into small caps a bit more recently, prior to last week, we didn't have that in Europe. So that defensive positioning is still there. So I think there's real scope for a rotation and an unwind, which could benefit our prospects of outperformance.
Mm-hmm. Another question here. In which countries do you typically find the most interesting small and mid-cap opportunities in Europe?
Well, it's quite interesting that I did two French companies earlier, because we generally don't find too many opportunities in France. I think the main areas that we find opportunities in smaller companies, but also in markets in general, is Northern Europe, so Sweden and the Netherlands. Mm-hmm. Sweden in particular, because it has a historical legacy of building multi-generational family-controlled companies like Atlas Copco, company we've owned for over 35 years continuously. And that's sort of been spun into more recently, where we've got this wave of entrepreneurial activity in Sweden, and that's despite having a really high social safety net. So I think I personally find that incredibly interesting. I remember at the early part of my career when I would interact with US investors around Europe, they'd say, is Europe too socialist for growth? Well, the Swedes certainly buck that trend, and we do find quite a few of these serial acquirers in these markets, but increasingly also in the Netherlands. So one of our largest holding is Topicus, for example, which is a Dutch headquartered company. And that is, again, a serial acquirer, but we also have really innovative businesses coming through there. But in general, it's in Sweden and Northern Europe where they have really healthy capital markets, where it's actually quite common to list your business on the stock exchange, even at a low level.
Mm-hmm.
And you can actually see from Instalco's price chart earlier, listed back in 2017, but still only 1 billion in market cap, and it's compounded its free cash flow at 33% a year. So that really shows that it listed at quite an early point. But I think overall Northern Europe.
Mm-hmm. I'm heading to Malta on my summer holiday, but I don't suppose you've got anything in there.
No, I don't think I've ever really encountered a Maltese listed company. I think that there are some gambling companies maybe headquartered there.
Mm-hmm.
I wouldn't know too much about the Maltese stock market. Perhaps too small for us.
And sort of, if you could give a broad overview in the next sort of 6 months in this, your small and mid caps in Europe, what do you see happening, and then maybe for the next 12 months?
Yeah, well, I thought I should probably now get my macro crystal ball out. But I think in the near term, things clearly look uncertain. I think probably the positive thing is that we haven't really observed in the past week that there's been material stress in the equity market. It's generally been the unwind of maybe positions that ran too long. Particularly for systematic traders or hedge funds or etc. It's really up to these companies to just deliver and execute at this point. We have seen, while we did see a bit of a recovery begin to come through at the end of last year and then the beginning of this year for demand. A good example is in bioprocessing for a company like Sartorius Stedim Biotech. We did see sort of a sequential improvement, but that started to tail off a little bit. And there's nervousness around that. But these companies are growing again from a very low base. So if they can continue to do that, I think there's an awful lot of value in reassessing people's small and mid cap allocation within their equity funds. I think we're able to take an all cap view, and that's beneficial for us because we can invest when they're attractive and sell when they're a bit more expensive. But whilst uncertainty will probably override contrarian ambitions in the near term, should these companies actually deliver the operational performance, we could be in for an interesting time. So I think over the next 6 to 12 months, that's really what we're looking for.
Mm-hmm. And obviously we've got a new administration here. We've got the Labour government in. Do you think that will have any effect on the sort of trade with Europe, or?
So we're investors in Europe ex UK rather than the whole continent
Mm-hmm.
itself, inclusive of the UK. I think this Labour government is keen to improve relations with the European Union, and hopefully what that will lead to is greater sharing, particularly around IP and greater collaboration on big projects, on technological projects, because that can only benefit the UK as an economy, but also the European Union as an economy as well, because that back and forth sharing, where the UK has a really healthy startup market, Europe has a reasonably healthy startup market, and the different universities that we have across the continent, that can only be good for the long term, better relations.
Mm-hmm. Great. That's all the questions that have come through. But if you just want to share maybe a few key takeaways for our advisor audience, that would be great.
Of course. So it's been a really tough time to be invested in smaller companies globally, and particularly also in Europe. But the question is, what will that persist forever? And so what I've tried to get across today is that Europe does offer some really interesting opportunities further down the market cap spectrum, secular growth type of opportunities, companies which have actually seen some weakness in the past few years, but which are expecting to see a resumption of normal business in the coming years. So that is hopefully has provoked some contrarian thoughts among some of you, which you can keep in your back pocket for later. Generally, smaller companies have traded at a premium. They currently trade at a discount. They offer long-term growth. And I think that, to us, creates a pretty attractive cocktail.
That's great. Thank you, Tom. That was a fascinating presentation. Thank you for your insights and for everyone who sent in questions. Now, before we wrap up, let's just take a quick look at those learning objectives again. By the end of this session, delegates will have learned about the historical performance of small, mid and large caps in Europe, understood why many growth investors find many of their ideas in the lower reaches of the European market, and heard about the secular and cyclical opportunities in Europe. Okay, that brings us to the end of our time today. Thank you for your questions, and thank you again to Tom for joining me and for letting me and you folks at home grill him with our questions. On that note, if your question didn't get answered, Tom and Baillie Gifford will do their best to do so after the event. Before we close up, I should assure you that your CPD will be delivered tomorrow. Let me just click back. And we just want to run you through what's coming up on our event schedule. We'll be kicking off our autumn programme straight after the summer break with another online working lunch on the 4th of September, where we'll be joined by a trio of regulatory compliance experts from Simply Biz, who will be shining a light on the key regulatory challenges which firms are currently facing, including online servicing and the Retirement Income Advice Review. Our expert panel will be focusing on what recent regulatory changes mean for firms and highlighting best practice solutions to ensure that you are able to meet your regulatory responsibilities. And we'll be back on the road again with a busy schedule of events in September, starting with our ever popular multi-asset roadshow, which kicks off at Rudding Park in Harrogate on the 11th. On the 12th, we'll be in Warrington, with 3 more venues the following week in Cardiff on the 17th, Bristol on the 18th, and rounding off the roadshow in London on the 19th. You'll see presentations from BlackRock, Downing, HSBC Asset Management, Quilter Cheviot, and Quilter Investors. Our keynote speaker for this series is Paul Tinkler, Head of Insight and Consulting at De Facto. On the 25th and 26th of September, we're north of the border with our regular Scotland Investment Roadshow in Edinburgh and Glasgow, respectively. Here you'll see presentations from 6 groups: Borgia, Downing, Evelyn Partners, Orbis, Quilter, and Simply Biz. Making sense of all these will be our keynote speaker, Square Mile Strategic Relations Director, Jock Glover. On the 1st of October, we'll be back in Warrington at the Park Royal Hotel and Conference Centre with our annual PA360 North Conference, where you'll hear presentations from over 20 industry experts, as well as having the opportunity to meet all our sponsors in the exhibition area of the conference. Do come along and network with our sponsors and your peers at what is now firmly established as the largest management conference for advisors in the north of England. All in all, that's 12 hours of CPD over the next few weeks. As ever, if you wish to find out information on or sign up to any of our events, you can do so by visiting professionaladvisor.com/events. That's it for today's session. All that remains is for me to thank Tom once more for his presentation and answering our questions. But as ever, our greatest thanks go to you, our readers, for your company this lunchtime. I trust you found the session helpful and worthwhile, and if you did, perhaps we'll see you again. Goodbye.